JP Morgan analysis. Are we bullish or bearish on this stock? Is it a buy, hold, or sell? Let's find out in this video. Hello everybody, this is StockerFinance. I am your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more details. So JP Morgan really comes down to this quote here that I think represents its stock in a very good way. Be greedy when others are fearful and fearful when others are greedy. That is a famous Warren Buffett quote there. What I mean by that is right now it appears that a lot of people are extremely fearful when it comes to JP Morgan and bank stocks in general. In fact, really around the whole market. We see greed in some sectors, but we also see a lot of fearfulness, especially around banks, airlines, etc., that are suffering really badly from the pandemic or that have the potential to suffer from it. Now, JP Morgan is down 27.82% from its pre-pandemic highs as a 52-week high of 141.1, a 52-week low of 76.91. So significantly below its 52-week high, but still actually pretty significantly above and had a nice recovery from its 52-week low. Actually has a wonderful dividend, which it's not cutting, at least not according to this quarter yet, of 3.63%. It's just had its earnings, its Q2 earnings, and we're going to take a look at that in a second here. Its market cap is $302.45 billion and a PE ratio of 13.37. So the stock graph doesn't mean much. We really just got to get into the fundamentals here and find out if this company is undervalued, if it's overvalued, if that drop in price from its pre-pandemic high was justified, or if there's a lot to worry about. What's going on here with the company? Let's find out. So these charts I'm going to be using are from hypercharts.co, by the way. Make sure to go check them out. Gallia Hyperchange founded or co-founded that website. It's a really easy way to display financial data. So shout out to that. Just got to give credit there. So here's the growth. Now we see revenue year over year and we see operating expenses year over year. One thing you obviously notice right away is the operating expenses have shot through the roof. And I'm going to talk about why in a second here. But revenue year over year has also grown pretty substantially. In fact, revenue has actually reached an all-time high Q2 2020, which is really surprising to pretty much anyone. Everyone thought this quarter was going to be atrocious or really just not very good. And instead, they reported an all-time high in revenue. However, you also noticed from the previous graph that operating expenses were really high. So we're going to take a look at net income and how that's affected in a second here. But one thing you might notice from revenue segments is there's two different segments here. There's net interest income and non-interest income. So JP Morgan is such a massive company that there's so many different ways and so many different income streams coming in. It's really hard to calculate all the different little segments of income for JP Morgan. So they did a really good job here of simply breaking it down into two sections, which is net interest income and non-interest income. So income they're making off loans, receiving interest or credit card interest, etc. And then just like fees or little things going on, or let's say their investment banking, etc., where they're making non-interest income. And it's pretty split 50-50 here. So now let's look at their net income. This is a different story. We had all-time high in revenue, but their net income does not display that at all. We actually saw a nice increase from Q1 2020, which is a great sign to see that they're recovering. But compared to its 2019 income, well, it's substantially below that, and it's still hurting pretty bad because their operating costs are up substantially. But why is that? Well, operating expenses here, one thing you'll notice is that non-interest expenses are really about the same, but the provision for credit losses has jumped substantially. Now, what is a provision for credit loss? Well, let's talk about that in a second here. But if we go back to margins, again, their margins, or if we go to margins for the first time, you'll notice that, of course, their margins have decreased substantially. Now, pre-pandemic, their margins were actually really good, around 40% for their operating margin, and their profit margin was around 25-30, actually increasing to about 35% in 2019. And then the pandemic hit and it just plummeted. But are they really not making that much money, or is there something else going on? Well, again, it goes back to that provision for credit losses, which increased substantially. But what is that? We got to find out. Well, what is a PCL, or provision for credit loss? Well, it's an estimation of a potential loss, and that's a keyword, potential loss, that a company might experience due to credit risk. They are expected losses from delinquent and bad debt or other credit that is likely to default or become unrecoverable. So, for example, during the pandemic, JP Morgan expects defaults as a result of this. And some examples might be businesses that took out a business loan to get their property, etc., running, or to fund a restaurant. And then all of a sudden the pandemic hit, all businesses are closed. All income stops for that restaurant, and they no longer can pay off this loan, which means JP Morgan won't receive interest on that loan, won't receive money to pay off that loan. Maybe that business goes bankrupt, and JP Morgan takes a loss on that. Now, when JP Morgan gives out loans, that's a risk that they are going to take. But just the whole pandemic thing really inflated that risk, because now income has been cut off. There's unemployment really high, so people aren't being able to pay off their home loans or car loans. Or again, businesses is probably the bigger one, where businesses are shut down and aren't able to pay off their loans, their commercial loans over there. So the good thing, though, is that JPMorgan and Co. set aside $10.47 billion to cover potential losses on loans to borrowers hurt by the coronavirus pandemic, cutting its second quarter profit in half, which we just saw with its net income. Now, the interesting thing here, though, is it actually isn't losing that money. It's just setting it aside and counting it against the second quarter profit. So it still has this $10.47 billion. This is what they expect. So I actually do think there's going to be a lot of defaults. But if there's less defaults than expected, well, that money is going to go back in to their profit, and they're going to make a bunch of money there. So the fact that they're prepared and are able just to set aside $10.47 billion, which in JP Morgan standards, I don't think is actually a ton of money. And we're going to see why in a second here, just because of how much assets they have under management. Obviously, it cut into their net income substantially, but again, they aren't just throwing it away. They're holding it just in case. And the fact that they were able to do that is a really good sign in my eyes, at least. Now, let's look at the revenue segments. So again, if we go back to revenue segments, they had, fantastic revenue. This is a great sign to see. And why is that? Well, they had a couple different sectors going on here. So first off, their corporate and investment bank posted a record $5.5 billion profit for the second quarter, which is more money than most entire banks typically generated before the coronavirus pandemic. Now, traders actually exceeded expectations that were already heightened for the quarter after management said in late May that markets revenue was headed for a 50% increase. That figure jumped by 79% to a record $9.7 billion, driven especially by strong fixed income rating. We also saw bond traders post a revenue of $7.3 billion, which is a 120% increase from a year earlier, crushing the $5.84 billion estimate by almost $1.5 billion. Equities traders posted revenue of $2.4 billion, beating the $2.07 billion estimate. Investment banking revenue climbed 91% to $3.4 billion on record advisory fees as big corporate clients tapped debt and equity markets at a furious pace to build cash positions amid the uncertainty of the pandemic. So their whole investment banking and trading sector of JP Morgan has really skyrocketed, even if credit card fees might be lower, even if there might be loan defaults that they're worried about and had to set aside a bunch of money for that. Well, their investment banking and trading is really keeping the entire company going and just adding to that revenue there. So now let's look at this Q2 2020 results. So average loans were up 4%, average deposits up 25%. That's good. And I'm just highlighting all the good things here, not the bad things. So average deposits up 20%, client investments and assets are up 9%. And that probably has to do with more people are trying to hoard their money. They're not spending as much. And that's why we see right here, average loans are down and credit card sales volume are down about 23%. Average loans are down 7%. Credit costs of $5.8 billion, including reserve bills of $4.6 billion. So a lot of people are hoarding their money, but they're depositing it into their bank, which JP Morgan can then use. Sorry, I'm fumbling my words here. Drank too much coffee today. But anyways, if we keep going down the list here, their total market revenue of $9.7 billion is up 79%, as I said. And income markets up 99%, equity markets up 38%. Gross investment banking revenue of $850 million, up 44%. Average loans up 13%. Average deposits up 41%. So the fact that their average deposits are up so much really just shows that people, again, are not wanting to spend money. People are really taking this kind of, mindset of I need to hoard stuff. I need to hoard items in case if something happens. I need to hoard my money. I need to save more. I don't want to spend more in case this whole situation gets a lot worse, which makes sense. But because of that, we're seeing a lot of their banking and a lot of their assets under management go up, whereas a lot of the spending and the fees they get from credit cards, etc., are actually going down. So again, that's why we see assets under management of $2.5 trillion, which is up 15%. And we see average deposits up there, up 20%. And the reason you see average loans up in some sections and average deposits up in some sections, because these are different sections of JP Morgan. So don't get them all mixed up into one big thing. And then we see credit costs of $223 million driven up by reserve builds. Now, I'm going to go ahead and just read what their CEO commented during the call here. That's in the top right corner if you want to follow along. So he said, I want to thank our employees, and this is Jamie Dimon, by the way, he's chairman and CEO. I want to thank our employees around the world for their exceptional work under the most difficult circumstances over the past several months. As one of the world's largest financial institutions, our actions are critical to keep the global economy going. From processing $6 trillion in payments each day, that's incredible, worldwide, to keep 3/4 of our nearly 5,000 branches open and safe, to meet individuals' financial needs. During these unprecedented times, JPMorgan Chase remains resilient and steadfast in using all of our resources to support colleagues, clients, and communities across the globe. Now, the big thing that I really care about here is the fact that they process $6 trillion in payments each day. That's an incredible amount of payments. And that, most likely, is down right now. So once they return to that, once people start spending more money in a year or two, it's going to be incredible, especially if their investment banking keeps up the momentum that they're gaining right now. Now, if we read the next little section here from Diamond, I'm sorry if I'm pronouncing that name wrong. He says, their balance sheet allows us to remain a part in the storm. We ended the quarter with massive loss absorbing capacity. Now, massive loss absorbing capacity. The fact that they can actually take a massive loss and be okay is a really important thing to recognize here. They have over $34 billion of credit reserves and total liquidity resources of $1.5 trillion on top of $191 billion of CTI capital, significant earnings power. And on top of that $10 billion that they set aside for defaulted loans. It's really incredible that they are able to, and it's a good sign, they're able to withstand a loss there, or a potential future loss or hit to their company. So now they said, our customers' needs remotely as well as in our branches. Card sales volumes are down, as I talked about, but have been consistently trending upward since April. So that's a good sign. Although card sales are down still, we've seen them start to recover as people start to spend more money again, and the economy slowly seems to sort of be picking back up. Seems some places reopening, some places picking back up in terms of spending power, especially around Europe and around the other parts of the world, even if the parts of the United States are still under full lockdown. So card sales or volumes are still down, but we're going to see that start to pick back up. So if their investment banking sector can keep up the momentum with these massive profits, and then as card sales start to recover again, the profits and the revenue for JPMorgan is going to increase even more again, which could be pretty substantial in the next few quarters, but we'll see what happens there. Now, they remained active in home lending on the strength of our digital platform, blah, 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 blah. All right, next section here. And I'm sorry if it's a little boring, but it's just really important when assessing a company, when analyzing a company, to review a lot of its data, to review the numbers here, and to really get an idea of how they're making money and really what's going on in the mechanics of a company. And with JP Morgan, it can be a little boring because, one, it's a banking company. It's not a technology company like Tesla where it's super exciting to be reading all about it. But JP Morgan is such a large company, and there's so much to it. There's just a lot of numbers, a lot of different things going on, and it can be boring, but it's important to make an assessment of, is this a buy, hold, sell, or what? Is this company undervalued? How are they looking into the future? A year from now, 2 years, 5 years from now, a few quarters from now? What is the situation with them? And right now for JP Morgan, it's looking like a pretty good situation so far. Although their book value of 76.91, which is up 4%, again, that's a good sign that their book value is increasing. So even though the whole world is kind of questioning banking right now and worried that a ton of defaults are going to happening, JP Morgan is basically saying that, yeah, it might happen, but we've set aside money for it, and we're actually very prepared for a massive default to happen, or for just a big banking or for a crisis or something, for things to get worse. JP Morgan is saying that they are prepared and can withstand that, which is a really great sign. So now, sorry about that. So now let's talk about some of the negatives for JP Morgan. Let's kind of take a bearish standpoint upon JP Morgan. And then it's really banks in general, and this is why banks are in trouble. So loan defaults are the main thing. We've already said that JP Morgan is sort of prepared for this, but let's talk about it a little bit and see if it could get out of control, how bad the situation really is. So loan defaults. Businesses are shut down. People are out of jobs. They're starting to run out of money. Banks are expect loan defaults, as JP Morgan stated. Now, no jobs, no income equals no loan payment equals a default. Closed business equals no income, no loan payment equals a default. And that's bad for business for JP Morgan. Now, the interesting thing is after 2008, we actually saw banks consolidate substantially. Sorry about that pop-up. And with these banks, they consolidated the number of banks, and then they consolidated the amount of assets. Now, this is a little worrying because that means banks aren't as diversified in general. And the ratio of net charge-offs, debt on loans, is unlikely to be recovered and actually increase. And what we're seeing here is the net charge-offs and total loans, again, was 0.36 in 2006, and in 2019 it's now 0.52, and I suspect that it's higher in 2020. Now, another thing that I need to point out here is just the fact that their commercial loans here are some of the most important, and are some of the largest loans that they're giving out. It was 1.2 trillion in 2006, and 2019 is 2.2 trillion. And I suspect it's a little higher in 2020, even at least towards the beginning of 2020, and they're giving out a lot more loans there. And the issue with this is that now businesses are closed, so they gave out the most commercial and industrial loans to now the businesses that are closed, that can't operate, that are suffering substantially. So the fact that they give out the riskiest type of loan and the most amount of that, or the second most amount of that besides residential and single family mortgage, but we saw the biggest increase in that since in 2006, it actually decreased since then, is pretty substantial and a little worrying. Now, JPMorgan can definitely withstand a hit, but if it gets really bad, then we could really see JPMorgan start to suffer here. So this is a risk that people have to be worried about, is if the pandemic continues and gets a lot worse and all these businesses start to default on their loans, or along with residential mortgages as well, JPMorgan is really going to suffer of it, especially if it surpasses that 10 billion mark that they had kept in savings there. But they did state that they can withhold it, so we'll see what happens. Now, again, the problem with this whole loan situation is at the beginning of the pandemic, the number of loans they were giving out was really high and interest rates were really low. So there's a really good, incentive for people to take out a bunch of loans then, thinking that, the pandemic will pass really soon. So tons of loans are being taken out at really good interest rates or really low interest rates. And the problem with this is we're seeing over time more and more defaults are going to happen. And that is why, and bigger defaults as well. And that's why we're seeing JPMorgan set aside this money. Now, the question really stands with, is that enough? Is that enough money for JPMorgan to set aside, or is it going to get a lot worse? Now, if we do a brief summary of JPM, their earnings, more revenue, but they're setting aside an emergency fund, which is really hurting their margins and cutting their net income basically in half. Their card fees are down because there's less spending, but deposits are increasing. An investment banking segment is gaining tons of momentum and earning a massive profit. Around $10 billion is set aside for loan default, which is a good sign that they can do that, but again, it's cutting into their income. And they have around $2.5 trillion under management, which is increasing, which is a good sign as well. So is this a buy, sell, or hold? Well, the fact that it is so much lower than its 52-week high is a good sign that you're buying it at a good price. If you're looking at this years from now, I would say JPMorgan is not too bad of a buy or a hold. Again, but one other thing we want to look at is simply its dividend yield, which is 3.63%. This is very overlooked, and it's a really fantastic dividend. If you invested $1,000 right now in JPM at the 3.63% dividend yield, which it said it's not cutting as of right now, is $36.3 every quarter when it gives out its dividend. Now you do 36.3 times 4 quarters is $145.20. You do $145.20 divided by 1,000. That is a 14.52% yearly return. And that's without compounding and without any stock volatility. That's a pretty good return. 14.52%, that's a pretty good return, especially in a pandemic like this. So even just to invest $1,000, hold for years, and just see where JPMorgan goes, especially if you're willing to take some near-term risk, it could be a worthwhile investment. Although JPMorgan might not necessarily be substantially undervalued right now, it is significantly below its 52-week high, and that dividend yield, in my opinion, really makes it worth it as an investment, at least in the long term. So, for my opinion, it's a buy and a hold. This is not investment advice. This is entertainment and informational stuff only. I'm not giving you, direct. I'm not telling you to buy JPMorgan. This is just my opinion. And also, in my opinion, it's a long-term investment. Don't expect it to double or some crazy thing like some of these tech companies are doing in the near term. It's a long-term investment. You're going to receive a nice dividend. And because they have this loan, or because they have this money set aside in case something bad happens, to me, that's a really good sign. Anyways, this was a long video. I'm sorry this ran on for so long, but thanks for watching. Please subscribe. I'm trying to hit 1,000 subscribers before the end of summer. Make sure to check out these videos, and please follow me on StockerFinance on Twitter for some fun stuff and more details as well. Anyways, it's StockerFinance, and I'll see you guys in the next video. Peace out.